Hello, class. Well, we made it to the final unit of the semester. Great job. Okay, we only got two things left. The last two things are kind of a mixture of managerial and financial accounting topics. You're going to find them in either book that you do. So we're in chapter 14. This first one, we're going to talk about the statement of cash flows, okay, which is the fourth major financial statement that needs to be made for financial accounting purposes. It's also very useful for managers because they're going to want to know what happens with their cash. And then in chapter 15, we're going to do a financial statement analysis. So we can take all this financial accounting information that we have learned how to make now in accounting 1 and in accounting 2, throw it all together, and how do investors, creditors, and even managers use that financial analysis information? How do they find it and how do they use it to make decisions? Okay, but that'll be chapter 15. So first, let's get going here in chapter 14. Let me get my my slides pulled up, get the slideshow started, and get it shared with you here. And then we'll be ready to talk about it. Screen share too. All right, the statement of cash flows. Oops. So we're just gonna talk about the statement of cash flows, how to prepare it using the indirect method. Again, as I said, this is a required financial statement. It is put out by the SEC that the statement of cash flows must be included in all the reports that publicly traded companies turn in. Okay. So what is the statement of cash flows though? Basically, it's going to show us how our cash has changed over a period. Okay, so if we look at our balance sheet at the end of year 1, we have this much cash. At the end of year 2, we have this much cash. Why? The statement of cash flows is going to tell us how that cash amount changed. Remember, when we're talking about cash, we're talking about cash and or cash equivalents. Cash equivalents are those highly liquid investments. Any short-term investments are going to come due within 90 days or less. That is included in your cash. Remember, cash is not just what you can physically touch. It's your checking account, savings account, anything that you have immediate access to that is not restricted for some other purpose. All right. So with cash, we're going to have cash inflows and outflows coming from major different activities. We're going to divide this down into 3 different activities. First is the operating activities. This is the ongoing day-to-day activities of the company. You can think anything that is going to be in the operating activities section. That's a funky stuff on my computer. I hope everything's working all right. It seems to be okay. All right, so anyway, the operating section, you can think anything that has to affect net income is going to be in that operating section. Sales, buying inventory, paying bills, stuff like that. When we're looking at the balance sheet, the operating cash flows, those are going to be associated with the current assets and the current liabilities as well, such as the inventory, the property, plant, and equipment, the receivables, okay, the accounts payable, the wages payable, the salaries payable, all that stuff, anything that is current. As you can see, when we get to going to doing a statement of cash flows, that is going to be one of the steps, is to analyze the current assets and current liabilities. Okay, second, so that's our first section of our statement of cash flows. This is how it's laid out. It gets put in this order when we're actually making the statement. Okay, so first we start with operating activities. Next, we go to investing activities. When we're talking about investing activities, we're talking about the buying or selling of property, plant, and equipment, or anything that has to do with another company's stocks or bonds. Okay, it would be investing in another company or investing in ourselves through property, plant, and equipment. And our third section is the financing section. Okay, financing section, when we think of financing section, we think of our own stocks and bonds. How are we getting money for financing? Are we issuing stock? Are we buying treasury stock? Are we issuing bonds? Are we retiring bonds? Are we paying dividends? Okay. So whenever we go to make a statement of cash flow, that's the first thing we need to kind of identify is what kind of activities do we have here. Okay, so pause the video with the screen on it. Maybe try to write down what each kind of these are. Okay, because right now I'm going to start going through and I'm just going to talk about what they are. So issuing long-term debt, that is our own bonds right there. So that'd be a financing activity. Paying cash dividends, we're paying dividends on our own stock. that is a financing activity. Reporting unprofitable operations. Okay, well, if it's unprofitable and it's operations, that is a normal operating activity, even though it's unprofitable, so that would be an operating activity. Issuing capital stock, here we're talking about our own stock, so that is financing. Reducing long-term debt, okay, that is an outflow, we are paying money out to make our own debt go down, okay, so that again is a financing. Retiring capital stock. Okay. Well, that's going to be kind of a non-cash activity because if we're retiring it, we've already bought it back. If we were buying back capital stock, it would be financing. That needs a little bit more explanation. Selling long-term assets, that would be investing. Profitable operations, it is an operating, and purchasing long-term assets is investing. What do they say number 6 is? 4 or 5. Okay, they say it's financing. So they're saying retirement of stock meant that they were buying that stock back before they retired it. So yes, that would definitely be financing because that's treasury stock, buying their own stock back. Some things of major importance that happen, okay? Investing in financing activities such as maybe, you know, we gave out stock for land, okay? Or we gave out stock for a piece of equipment. Those do not affect cash, but they have a significant effect on the company. Those must be listed at the very end of the statement of cash flows in the supplemental information, just as a disclosure, as a note put in there. Just kind of remember that. So there's 2 different methods to calculate the cash flows. There's the indirect and the direct method. The indirect method, we are going to start with net income and make some adjustments to it to find our cash. Whereas the direct method, you have to adjust each line item on the income statement to your cash flow. So when we're looking at sales, we need to know how much is sales and how much is credit. And then we need to know how much we collected from the credit sales. Okay, the direct method is very difficult and very complicated. There's a lot of T account analysis. We are not going to touch the direct method in this class. Okay, that's more of an intermediate and an advanced accounting topic there. Most companies are going to use the indirect method. Therefore, that is what we are going to teach you, the indirect method. So here's what we do. First, we're going to compute the change in cash for a period. And that's fairly simple. We just look at 1 year compared year 1 compared to year 2. How much did our cash change? That gets us our control number. Cash. Step 2 is operating activities using the indirect method. Step 3, we do investing activities. Step 4, we do the financing activities. Then 5, we're ready to prepare the statement. Okay, so here we go. How to compute the change in cash? Well, look, in 2000 X2, we had 175, and X1, we had 70. Cash went up $105,000. There's the answer to that one. Simple enough. So we know when we get done now that our statement of cash flows needs to be $105,000. And when you're doing your homework, your problems may be all linked together, but they're not going to work out exactly that way just because of the way the software is set up. You'll see when we go, if you watch the handout and go through the example with me, you'll see what I mean. All right, so step 2, we need to change. We need to get our cash from operating activities. Okay, so when we do this, I have it broken down here into basically 5 steps. First, you're going to always start with your net income. Okay, I go in a little bit different order than what's on this slide here. It's the order I was taught. It's the order I like. Okay, does it make sense to me? Okay, so the first thing I'm going to do after I start with my net income is I'm going to add back any non-cash expenses. Okay, the major non-cash expense that we're looking for here is depreciation. Okay, you think maybe amortization expense too. Also, there's no cash involved in that. Okay, but the main one you're going to see is depreciation. So you always have to add depreciation expense back to net income, which makes sense because if we say income is our cash flow and we subtracted out depreciation expense, well, there was no cash flow going on, so we add that back in. Okay, step 2, we look at our current assets. We compare year to year. We have an inverse relationship here with our current assets. Therefore, if the current assets increase from year 1 to year 2, we are going to subtract them from our net income. And the exact opposite is true. If our assets decrease from year one to year two, then we are going to add them to our net income. Step three is to examine our current liabilities. Now, these are the opposite of the assets, okay? They have a direct proportional relationship. Whereas if the liabilities increase from year one to year two, we will add it to our cash flows. If they decrease, we will subtract it. Okay, so there's step 2 and 3. And finally, step 4 is we need to eliminate any items that belong in the investing or financing section, meaning we need to get rid of the gains or losses on sale of equipment or investments. Okay, because that is put into net income, we are going to just remove it, do the opposite. So if it's a gain, we need to subtract it. If it is a loss, we need to add it back. Okay, so those are our 4 steps in computing operating cash flows. So here's our example. How to compute it here, we start with our net income, okay? Our accounts receivable. As you can see, it went down by 27,500. Since it went down, we need to add it to our cash flows, okay? The decrease in accounts payable. It has that direct relationship, down. Increase in inventories. Again, it is an asset, so it has the reverse relationship. An increase makes you decrease it. Depreciation expense always gets added back, and then the gain gets taken out. Okay, and we'll go through that again in the handout. You get plenty of practice on it. Just remember those those steps. Start with net income, add back non-cash expenses, examine assets with an inverse relationship, examine liabilities with a direct relationship, and then finally look at gains and losses, add back or subtract out gains, add back losses. All right, next when we look at investing activities, we're just going to look at the direct cash payments. Okay, we're not worried about the gain or the loss of the accumulated depreciation, what was on the books at that time. We are just trying to track the direct cash payments. Okay, so equipment with a book value of 50,000 was sold for 70,000. New equipment was purchased. All right. So here we have to look at this. What is happening to our investing section here? Okay, so our property, plant, and equipment went up by 10,000. Okay, we were told that it had a book value of 50,000, was sold for 70. Okay, so we have a cash inflow of 70,000. We know that, right? But new equipment was purchased. We have to remember how equipment is recorded. It is recorded into the plant and equipment at its book value. So if at X1 we had 400,000 and we sold 50,000, now we have 350. If new equipment was purchased, how much did the new equipment have to cost? It had to cost 60,000. Does that make sense? I hope so. Okay. So we received 50,000 for sale of old equipment. We purchased new equipment for 60,000. So that makes that go to 10,000. And then it looks like our land increased. So we must have bought some land too. Did I do something wrong here? I did, didn't I? Let's go back to previous. Oh, I did. The original cost was 90,000. So the 90,000 would have been on here. So that would have went down to 310,000, meaning our purchase had to be 100,000. Okay, we still receiving the 70,000, purchase 100,000, purchase of land, net cash from our investing activities. Again, hopefully you can get this from reading the slides. If you didn't understand my example here, if it's still not clicking in and making sense, come watch the handout video because we're going to do a question just like this, and we'll write out the calculations for you. Finally, we compute financing. Again, we can just look at this. If we had a mortgage payable here and it went down, we paid out 100,000 in cash. Common stock didn't change. That didn't change. Retained earnings. Well, here, what goes into retained earnings? We need to remember retained earnings. We can take our beginning balance, add in our net income, and then subtract out any dividends. Okay, to get our ending balance. Okay. So we had no mortgage. Now we have a mortgage payable. All right, so that means we borrowed money. So we got cash inflow of $100,000. And then we paid out dividends by doing that formula there that I told you here, retained earnings plus your income, less your dividends get you your ending retained earnings, okay? So they just put it up there in a different format. And finally, we prepare a statement of cash flows. This is what it's, whoops. This is what it should look like. Your company name, statement of cash flows, it's a year ended statement. Then you have your cash flows from operating activities, cash flows from investing, and cash flows from financing. All right, so that's it for the chapter 14 video lecture. Be sure to watch that handout and we'll run through how to calculate all these. And all. It's a little bit easier to understand this too when you see me writing it out and actually doing the calculations while I explain it. So be sure to check that out. I have a chapter 14 video for you, then chapter 15 video, and that'll be it for the semester. Keep up the hard work. You are almost there. Do not quit on me now.